Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending August 2nd, 2024. And it was a wild week. I have a lot for you during this session because there's just a lot over the last week. We had the Fed meeting, we had jobs report, we had just the Bank of Japan, so much, okay? Now this week I'm going to title the video Volatility Spikes, Time to Panic, question mark. And that's the big question. I think some people are panicking to a degree, but what does the data underneath the surface really say? Okay. And that's what we're going to dig into today. Now, I love this heat map. This is the 1 week performance of the Russell 3000. I could switch over to the S&P right here. That's a little better. But basically, Apple and Meta were the only two of the Mag 7 that really held up during the week, okay? You had NVIDIA down 7, Microsoft down 2, Google, I guess that would be flat, Amazon down 7%, Tesla down 6%. But what you can see here is there's still a decent amount of green, right? Especially healthcare, consumer durables, right? Those non-cyclicals, utilities did well, health services. So the non-cyclical names definitely did better. And I think that will probably be a theme for the short term, but we'll talk about this in a little more detail coming up. But I want to start off with this chart, which is basically the Morningstar style box. And this is the 1 month. So I just showed you the 1 week, and this is the 1 month. Large cap growth down nearly 10% over last month, where everything on the value side continues to be in the green, although obviously much worse across the board after this week. So very interesting time in markets, and I'll show you the charts in a bit, but I want to get to some of the economic data because there was a deluge, and this is where the basis of the answer, time to panic, will come from, okay? And so this is, we had total job openings, I believe that was on Monday or Tuesday. That ticked down a little bit. You can see that continues to be in a downtrend if you go 5 years, right? We're almost back to pre-COVID levels, but we continue to see that fall. And I do think that's it's not the greatest number to follow anymore because so many jobs are online. And I do think there are multiple jobs being posted across the country for one particular job, but it's counted as multiple jobs. So I don't love that data set, but interesting to see that on decline. The ADP number came out on Wednesday, and you saw that tick down to 122,000 jobs. So that was kind of a harbinger of things to come. U.S. Employment Cost Index, that did tick down in the second quarter. Now, that is lagging data, but good to know, the wage pressures continue to ebb. And unemployment claims for insurance, that was on Thursday, and that one ticked to the highest level since, what are we, back in August of last year. Okay, so, and then you couple that with the continuing claims. So I always say a lot of people follow, you'll see headlines about initial claims for unemployment insurance. But if you lose your job and you get a job in 2 weeks, a new one, is that the end of the world? Probably not. Okay, but if you stay on the unemployment rolls, which that's what this is, continuing claims for unemployment, that's where it becomes an issue. That's where you can no longer pay your mortgage, your credit card, maintain your lifestyle. Okay, and this is at 1.877, and that is now higher than this peak here. This was at 1.86. So that means that we are at the highest level of continuing claims since the beginning of 2022. So 2.5 years, over 2.5 years. So very important context there. Construction spending did come out as well. That ticked down again for the second month in a row. Once again, this is lagging a month of June, so it's a little old, but just shows you the higher rates and the problems in the commercial real estate market are certainly weighing on construction spending overall. U.S. productivity, this is a positive for the second quarter, 2.3%. Remember, when companies get more out of their workers, that means their profits rise and they're less likely to lay off their workers because their workers are doing right by then. You're doing good. And, this ticked down in the first quarter. It was definitely something to worry about, 2 quarters in a row where it ticked down pretty extensively. but now we're ticking back up. So that is a positive and something you want to continue to watch. Average hourly earnings. This is what came out on Friday. That did tick down to 3.63% year over year. So once again, wage pressure continued to ebb. Now the headline number, 114,000 jobs. That's down from a downwardly revised 179,000 jobs in the month of June. So worse than expected. Average economists expecting 175,000 jobs. Now there is a caveat here. The hurricane, Bayern or something like that. That one, they say that it didn't impact this number, but it did impact the unemployment rate, which it did tick up from 4.1. I don't have that chart here, 4.1 to 4.3. That did affect that because remember, there's different ways that they're calculating the number of jobs created versus the unemployment rate, and so we'll see if that's the case, right? They say that this 114 number wasn't impacted, but a lot will depend on what the month of August looks like to see really if this is more of a one-off or there's something more consistent with this trend. That's you're getting another stair step lower in the labor market. You had average weekly hours that ticked down to really a 1 year low. So that continues to be in the downtrend. And this is a great article from Morningstar. Just, what are the caveats here? The household survey had unemployment down 0.1% year over year, or total employment down 0.1% per year, but the non-farm payroll has up 1.6% year over year. So some differing of opinions there. And really it's going to be, once again, what happens next month or call it this month, when we get that jobs report in early September. And so that'll be very interesting. Now, the Fed, the jobs report moved the odds of a rate cut in September to not just one rate cut, but potentially a 50 basis point cut, right? 22% chance there. This has moved, right? This is actually flipped yesterday, and now it's flipped back. So I think that there was a little of a freak out that the Fed will go extreme and go 50 basis points. Things are so bad, but obviously the market is kind of settling down here, and I think that's correct. I don't think they need to go 50, but obviously a lot will depend on how the economic data throughout the month comes in. And then there's Jackson Hole. Remember, Jackson Hole comes up later this month, and that's usually a place where there's a major policy shift, meaning that they're going to talk about how this new rate cutting cycle will likely evolve, what they'll be looking for, et cetera, and that will color market expectations as well. So that's kind of the next big event before the next Fed meeting. The Atlanta GDP now figure, remember this is from the Atlanta Fed, their estimate still is 2.5% growth in the third quarter. So that's their live update based on the incoming data. Yes, that's come down a little bit from closer to 3 a few weeks ago, but ultimately no recession, at least in the near term. And this is the most important part. This is where I'm getting to the most important part of answering the question, should you panic? And the simple answer is no. Why is that? Because look at bank credit, okay? Bank credit, when bank credit falls, and a lot of people don't understand this, is they think that the Treasury and the Fed, they're the ones in charge of the money supply and creating money and all that. No, the banks in a fractional reserve banking system, if the banks are lending, leveraging up their balance sheet, that is creating dollars into the system. And so where bank credit is going is vital. Okay. And what you see here is this is '08, right? That big crash, deflationary impulse there. Same thing with 2000, right? Bank credit rolled over, and then you had the expansion. And so we've been on this expansion until 2022 when credit fell. But what you see as of late is credit is rising once again. Okay, this is year over year, and that is a positive for markets, and so or just for the economy in general. And then you add on top of that the that the Fed is starting to ease, that should ignite more lending demand, right? You're talking about refinancing loans that maybe were untenable at higher rates, and now suddenly there will be more refinancing there, okay? More activity and just more growth in that lending. And so that looks to be headed higher, and I think we're at the start of the next up credit cycle, positive credit cycle, to be frank. Now, another big factor, and this is there's two main factors into kind of the broader trends in the economy, and that is, are banks lending to create more money in the economy, and is the government spending in order to put more money in the economy, right? Because if the banks aren't lending, but the government is out there, like in 2020, giving people checks, that also is expanding the money supply. Okay. And so this is with a forecast. Okay. So what you can see is 2023, we had a deficit of $1.4 trillion. This year, it's expected to be 1.5 trillion. Not a giant increase, but it's increasing, right? And remember, if this is going down, if the number is more negative, that means that the deficit is rising. Okay. And so inflation adjusted, it's still growing at a positive rate. And you really get in trouble when you see the deficit declining. Let me go all the way back here. Look at this. Going into 2000, right, the deficit was declining. We actually went into a surplus. And then you had banks stop lending. And that's when, really peaked in, late 98. But early 2000, excuse me. And so you had the combination of banks stopping lending and the government deficit shrinking or surplus rising. Okay. And then you have '08, you had this same thing, right? 07, 06, 07, 08. This was rising, which means the deficit was falling. And then you had the rollover in credit. Okay, so that's where you get into major problems when you have a combination of bank credit rolling over and you have the government deficit falling in real terms. Okay, and so we don't have that right now. We still have the deficit rising. Let me go back to a shorter term chart. We still have the deficit rising, right, going from 1.4 to 1.5 trillion, and you have bank credit on the rise as well. So when I say, and I ask the question, is it time to panic? The simple answer is probably no, because of those two main factors. Okay, doesn't mean you can't get more volatility in the near term. You certainly can. And I'll start with this chart here, which is, let me clean this up here, because these ones, at least right now, are kind of irrelevant. These are support area levels. But basically, the next major support, and this is a fib, I'll zoom out here. This is the lows in late 2022. Remember, that's when bank credit stopped falling. It was in late 2022, early 2023. And this is that move. Okay, this is actually from this pivot. There we go. So you can run two fibs on top of this, and there can be multiple support levels based on those pivots. But ultimately, this is kind of the area that I think we will get into, which is on the S&P between, let's call it 5,075 and 5,100. Right, 5,125 in that range. That's ultimately where I think we'll go. Now we're into the 100-day moving average. This 2.5 retrace is going to be pretty decent support. So do we get a bounce here? Certainly possible. Okay, certainly possible. But I do think you get another kind of ABC pattern where you get a move lower, you get a bounce, and then another move lower, probably into the fall, and then you get that bottom and the Christmas rally. You obviously are into seasonality. August, September tend to be more volatile. We have the election coming up, obviously a contentious election, and so a lot could happen between now and let's call it November. Was it November 6th, November 7th, so early November when the election is. Now let's go to the yen because this is obviously very, very important. I talked about it last week, and the yen continued to move higher. The market expected the Bank of Japan to raise by 15 basis points. They raised by 25 basis points, and they instituted QT. So that is a very hawkish tilt to their policy, just as the Fed is looking to cut rates. And obviously, as I showed earlier, expectations for those rate cuts continue to move to the upside, right? So you have this pivot on both sides in opposite directions, and that's why you're getting that move in the dollar yen. But it's not just the dollar yen that's weak. That's shows a weak dollar. Look at the euro, right? Euro is up big on Friday compared to the dollar. Okay, look at the Swiss franc. Okay, also up big. So, what you're seeing here is a dollar. This is the broader basket, the US dollar index, and you're seeing this certainly roll over. So that's a very, very important chart to continue to follow. And also, that is actually good for economic growth. Remember, a weak dollar is good for broader stability in the financial system, especially in foreign markets, the euro dollar market, et cetera. The growth to value trade, this is the ratio. So we've talked about this before, right? You got this. This is all the AI hype from earlier in the year until recently, and that's kind of all coming off right now. And so a weaker dollar will continue to spark this because a weaker dollar should, in the medium term, improve the economic outlook, even though the market's reacting to a short-term weakening in the labor market. I still expect, this looks like it's ready to probably get a little bit of a bounce, and probably would coincide with a little bit of bounce in the overall market. But I still think that trend of value over growth is going to reassert itself. This is small caps, so IWM. Obviously, the recent worries about the economy have pulled this back, but ultimately, I still think this is in a much more constructive position than the S&P or the Qs. Right here, the Qs. This is also getting to a decent support level. This is the 2.5 retrace from the 2022 lows, and do you get a little bit of a bounce here before the next move, which I could easily see getting down to this 408 on the Qs. We can go over to the NASDAQ. There we go, comp Q, there we go. And I could run a similar fib. Let's go to a weekly chart. Okay, let me go here. And then there. That's close enough. Close enough for government work, as they call it. Yeah, so we're into support right now. Is a bounce possible? Very possible. But ultimately, it's probably a weak bounce for that next move lower into where we were in April. So that's what I expect for the NASDAQ. And speaking of peaks, look at volatility, right? Volatility spiked all the way to 30. Typically, when you get this type of volatility spike, that does create at least a short-term low. Doesn't mean that has to be the ultimate low for this pullback, but that is an indication that at least near term, you could see more. You could see more of a bounce. Okay. Okay. So let's get to gold. Right, gold has pulled back a little bit, but still, this is very strong. Okay, same with silver, pulled back a bit more, has a little more correlation with the broader economy, so not a shock there. Does tend to be a bit more volatile. The miners did pull back with the overall equity markets, but still, this is in good shape overall. What are the sectors doing well? Utilities doing well, and it did kind of pull back and closer to the lows on Friday. So I think near term, you could see a bit of weakness here, but ultimately, I think utilities have some nice headwinds. With rates coming down, here's the IEF, the 10-year Treasury. I could pull this up too. Here's the 10-year over here, right? 10 years down to 3.8%, the lows we saw back at the beginning of the year. So I think this probably continues even lower to be honest with you, in the near term. I think 3.5 is probably the bottom in rates in the short term. So don't be shocked to see something like that happen, and obviously that will benefit the bond proxies, and utilities are bond proxies. Also, you have real estate. So here's the XLRE, that one sticking to highs of the year, and that is certainly a positive for that sector. What were the sectors that didn't do well? Materials, that did pull back, but still, this is not in a bad place overall. This is just a bullish consolidation, frankly, after this move, right? You aren't making any major new lows or anything like that. We're still above the 200-day moving average. I think that still looks relatively positive. Energy, that looks much weaker, but still held those lows. I think that was a positive. I think what will be important is, do we hold this 86 level on the XLE, which is that 382 retrace, sorry, the 618 retrace from this low, and also, this kind of consolidation area breakout. And so that should contain any downside in the XLE in the near term. If it doesn't, more could be wrong with the energy space. So we'll be continuing to monitor that. Let's go to the SMH. This is semiconductors. That has been definitely the weakest. Look at the MACD now below the zero line. I think this has more room to the downside. NVIDIA, it's holding up better than most, but still, you have AMD really look at this, from a high about 225 all the way to 132. Intel obviously had bad earnings. It did close near the highs of the day, so we'll see if we get a bounce into next week. But obviously they suspended their dividend, laid off some workers. So a lot of work still to do. I thought that they would potentially have more in the tank to fight against the AMDs of the world and then NVIDIAs of the world. And they did have some traction with their AI chip, so maybe this is a bit overblown, but we shall see. Let's go to the MOVE index. This is another one that I continue to watch. This is obviously the volatility of the treasury market, and if this is headed higher, that is not good for equities. So that needs to stop, at least somewhere below 140, 150 in that range. If this starts to spike up to 140, the Fed's probably going to have to ease faster than the market is expecting. So this is one indicator I'll watch to see how aggressive the Fed is in this easing cycle. I think that's about it. I covered a lot today. It was a long video, just because there's just so much to talk about. And hopefully I answered that question. Is it time to panic? Simply no. But that doesn't mean you can't have more volatility between now and, say, the election, and doesn't mean you can't get down to this 5,000 level on the S&P. Remember, you should always expect a 10% pullback in markets in any given year. That's typical. This peaked at 56, 67 or so in that range. And, getting down to 5,000, that would be roughly, a little more, 12% pullback. Okay. So these are normal in markets. These are what you should expect in markets. If this is freaking you out, if this is making you uncomfortable, you should not be taking the risk that you're taking. Simple as that. Okay. And if you ever need help, we're always here to reach out. We do portfolio reviews and be happy to go over your portfolio, analyze it, help you understand your risk, etc. But I thank you again for liking and subscribing to this video and this channel and our podcast, InvestTalk. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.